For our topic for today, that's about pricing and profitability analysis. So this is our module 2.A or part 1. Okay, so to start with, so let's have a small overview. So one of the most difficult decisions facing a company is pricing. So the accountant usually is the primary resource of the firm when it comes to financial data that they need, whether that information is related to cost or to pricing. So therefore, accountants must be familiar with the resources or the revenue data as well as the economic and marketing concepts needed to interpret those data. For our learning objectives, so at the end of this module, so you should be able to, number 1, discuss the basic pricing concepts. Number 2, calculate the markup on cost and a target cost. And number 3, explain why firms measure profit and calculate measures of profit, as well as calculate measures of profit using the absorption and variable costing. So for the content of this part of the module, so we will discuss about the basic pricing concepts, cost and pricing policies, the legal system and pricing, as well as the measuring of profit. Okay, to start, we will first discuss about the basic pricing concepts. Okay, so basically, when talking about the basic pricing concepts, we will have a some sort of review about the topics that is related to economics. So of course, talking about the demand and supply. So if you could still remember in your economic subject, so we have what we call the law of demand and supply, which of course is affected or influenced by the price and vice versa. So meaning to say in this case, if the demand is higher, okay, and the supply is low, then okay, the effect of that would be to increase the price because there is lesser supplies that cannot cope up with the demand. So that therefore, okay, the effect is to increase the price so that the demand will ultimately reduce. Okay, because there will be lesser consumers who are able to afford. Okay, because of the increase in the price. And on the other hand, if there is so much supply and the demand is less, then the tendency is to lessen the price so that the supplies could be disposed of and the consumers are able to um, afford, okay, those goods and services. So of course, this demand and supply has also its price elasticity. Okay, but in this case, we will be reviewing about price elasticity of demand. So in this case, if you could still remember, we have different classifications of elasticity. So we have uh, purely elastic, inelastic, and purely inelastic. So of course, again, this is also affected by the price. So meaning to say, if the demand is elastic, so the consumer's decision for purchasing or buying is primarily um, affected or influenced by the level of price. Okay, so meaning to say, if there is an increase of the price, then the tendency is there is a greater level of change on the part of their demand. So it will also decrease. Okay, because in this case, we have an inverse relationship between the price and the demand. Okay, however, if, for example, there are changes in the price and the consumer are still able to afford and their demand does not change materially, then that is what we call inelastic demand. Okay, so again, this concept of elasticity is of course affected or influenced by the level of the price. So that's how important price is. Okay, the third is the market structure. So of course, when talking about the market structure, here the prices of the goods and services also takes its important role. Okay, because again, normally, if we could notice, this is actually related to the demand and supply, okay, concepts, because if you could still remember in your economics, demand is actually the driving force of the market. So again, demand is, as mentioned earlier, that is affected or influenced by the price. Okay. So these are just a sort of a short review so that you will grasp the importance of pricing. How is it essential? Okay, in the market. Okay, in the consumer, in the demand and the supply. Okay, so we have here the characteristics of the four basic types of market structure. Okay, so we have the perfect competition, monopolistic, oligopoly, and monopoly. So here, the number of firms. Okay, as you could notice also, this is just again the sort of short review of your economics. Okay, so barriers to entry, uniqueness of the product, expenses related to structure, and type. So again, this is just a sort of the price, basic concepts in economics that also plays an important role on the uh, role of price in the market. So again, just a sort of a short review of these concepts. Okay, so we go now to the cost and pricing policies. Okay, so cost-based pricing. So here, demand is one side of the pricing equation, and the other side is the supply, as we have explained earlier about the law of demand and supply. So since revenue must cover cost for the firm to make a profit, and we all know that, many companies start with cost to determine the price. So that is, they calculate the product cost and add a desired profit. So this is actually the common costing method that is cost based. So basically, the manufacturer, the sellers are determining how much is their cost of goods sold or cost of sales or cost to manufacture, or all cost and expenses that is related to the production and sales of the product. And then after determining this cost, they just add a desired level of income or profit so that they will be able to gain. Okay, and that they will sell these goods and products at a higher than its cost so that they can be at a loss. Okay, so again, this is the most common pricing method. So to continue, so the mechanics of this approach are straightforward. So usually we have some cost base, that is the total cost for production, selling, and other expenses that is directly or indirectly related depending on the concept of the company on how they accumulate the cost, okay, and compute those costs. And they also add markup for the profit. So the markup is a percentage that will be applied to the base cost. So this includes your desired profit or any costs not included in the base cost. So the companies that bid for jobs routinely base also bid price on cost. So again, um, this is just adding a markup to the cost and expenses for producing and selling the goods or services to get a desired profit. So to understand better, we have here the illustration. So we will use Audio Pro company that is owned and operated by Chris McAnders. So they sell and install audio equipment in homes and vehicles. So we have direct materials and direct labor. So they can easily be traced to the jobs. So assemblers, They also receive an average $12 per hour. So the income statement is provided as follows. So we have there your income statement for the last year. So Chris wants to find a markup on cost of goods sold that will allow them to earn about the same amount of profit on each job as was earned last year. So for the requirement, we have three. So the first requirement is, of course, what is the markup cost on cost of goods sold that will maintain the same profit as last year? So second, suppose that Chris wants to expand their company's product line. So they will include automobile alarm systems and electronic remote car door openers. So they estimate the following costs for the installation. Okay, so the total cost is $140. So what is the price that Chris will use for this new product given the markup percentage that we calculated in requirement number 1? Okay, and for the third requirement, what if Chris wants to calculate markup on direct materials cost since it is the largest cost of doing business? So what is the markup on direct materials that will maintain the same profit as last year? And what is the bid price that they will use for the job given in requirement number 2 if the markup percentage is calculated on the basis of the direct materials cost? Okay, for the solution, so number 1, for the markup on cost of goods sold based on the given data. Okay, so all we have to do is to add all the costs and divided by it by the cost of goods sold to get the markup percentage. Okay, so therefore, based on the data, so our selling and administrative expenses as well as operating income is, okay, that's okay, or divided by the cost of goods sold, I mean. So our markup on cost of goods sold is 43%. So again, here, our basis is cost of goods sold. So that is our 100%. So if you could notice in our numerator, aside from the expenses and cost, we also add up income. Okay, because income plus your expenses is actually the total sales. Okay, and the total sales is already incorporated, or they has already incorporated the markup on cost of goods sold. That's why we added that up, okay, on the numerator side. Okay, so that's why this is our basis for computation. Okay, so that's 43% of cost of goods sold. That's how that's the percentage that they add or mark up on the cost of goods sold to get the sales. Okay, for the second requirement, okay, so for their new product, so for the installation of automobile alarm system. Okay, so the price that will be used for this new product, given the markup in requirement number 1, so the price for the new product is, so its cost is $140. So we will just add 43% to it. So therefore, its price now is $200.20. Okay, and the third requirement is, okay, what if we will base the markup on direct material cost? Okay, so if you will base that on the markup on direct material cost, so all you have to do is, okay, to have this formula. So we will add direct labor, overhead, selling and administrative expenses, as well as operating income, and divide it by direct materials. So again, please take note that we have added other cost and expenses, okay, except direct material, because in this case, direct materials is our 100% or our base. Okay, and we also added the operating income because this all of these expenses plus the operating income will now comprise the total sales. okay, which is again already included the markup on direct materials. Okay, so that's why this is our formula. So if you will base the markup on direct materials, so that is equal to 186%. So of course, you might wonder, that's very high percentage. That is actually anticipated because direct materials, although they consider direct materials as one of the largest costs, but it's just one component of the cost. There are other costs or expenses that the company has incurred, okay, along with it. So for the bid price, okay, so that's 80.60, okay, plus our markup on direct materials. Okay, so that's the bid price is 230 point, okay, 52. So 80.60 is our base, which is the direct materials. So we just added 186% to it, okay, to get the uh, bid price of $230.52. Okay, so that's for the cost-based pricing method or approach. Okay, so we can now to the second approach. This is what we call target costing and pricing. So target costing will set the cost of the product or service based on the price or target price that customers are willing to pay. So the marketing department will be the one to determine the characteristics and the price for the product, so that are acceptable to consumers. They can actually do this through surveys on their potential and existing consumers. So it is the job of the company's engineers then to design and develop the product that such cost and profit can be recovered by that price. So of course, it will be designed by the engineering department, and the accounting department will now be working hand in hand with them to determine the cost, if that actually can cover uh, the price that is being set as a target. Okay, so here, retail stores, in the case of retail stores, they engage in the form of target costing when they look for goods which can be priced at a particular level to appeal to the customers. But of course, they take into consideration their costs as well, okay, so that they will be able to sell it above its cost. So here, to illustrate, so we will use the previous illustration on Audio Pro. So suppose in this case, they find that other aftermarket audio installers also price the remote car door opener at $155, while their initial price was, as computed, is $200.20. So, if we could notice, they sell higher compared to their competitors. So, should they drop their plans to expand into this product line? Okay, because it's much higher compared to what is already existing in the market, or as what their competitors are offering to their customers. So here, the original price called for based on materials is $80.60. Okay, and $36 of direct labor. So perhaps they could offer one remote device instead of two, so they can save $15 in cost. So that's their first option. In addition, also, they might be able to shave some time of the direct labor once the workers are trained and able to work more efficiently. So this would result also in $16 savings. So the prime cost will be that is our direct materials and your direct labor. So your direct materials will be deducted by $15 because in this case, they could offer one remote device instead of two. So meaning to say they will use lesser amount of direct materials. Okay, and if they are able to shave some time off on the labor, direct labor, so they can also save up to $16. Okay, so um, here the prime cost will be $85.60. That is the sum of your direct materials and direct labor. So compare that to the original of 116.60. So this is their option, okay, to lower the cost and to lower also their price. Okay, so their target, of course, is to at least level their pricing with that of their competitors. Okay, so next, Audio Pro company applies overhead at the rate of 65% of direct labor cost. However, they must think carefully about this job. Okay, because in this case, it's quite large. Okay, in terms of percentage, it's 65%. So perhaps somewhat less overhead will be incurred because purchasing is reduced. So their overhead for this job will amount to, if that is 50% only of the direct labor, so $10. So again, that would make the job for one, uh, or that would make the cost of one job at 105.60. So this cost is already, we have already incorporated the reduced savings on direct materials, direct labor, and factory overhead. So in this case, they were able to cost this job at 105.60. Okay, so in that case, now if the standard markup of 43% would be applied, okay, the price would now be $151. So that is equal or the same with that of their competitors. So within the firm's price, okay, so target pricing is an iterative process. So here, they will have to set some rules, guidelines, and reductions also of the cost so that they will be able to uh, reach their target costing and pricing so that they can compete in the market. So here, so they will go through the cycle until either they achieve the target cost or determine that they cannot. Of course, at the end of the day, they should not what do you call that? They should not make it up to the point that they will be losing. Okay, so again, if they cannot cope up with the competition, then they should uh, not offer that product at all. Okay, instead of losing or incurring losses. Okay, so that's for the target costing and pricing. Okay, so the next is other pricing policies. So here we have price scheming. So in this case, when we see price scheming, that means a higher price is charged when a product or service is first introduced. Okay, in essence, the company schemes the cream of the market. So normally in this case, because especially if the goods or products is unique and uh, that particular good has no other substitutes or the same product that is already existing in the market. So in this case, they can set higher prices, okay, for those product or services. Okay, so until such time that there would be a competitor that would create the same or substitute product, then they might think twice as well to reduce their prices so that they can cope up with the competition. But again, price skimming is introduced for introducing a new product with higher prices. Okay, so it is used most effectively when the product is new, There is a small group or customer that values the product or service, and the company enjoys a monopolistic advantage. Okay, so this is the case where price skimming can be used. So next, companies that engage in price skimming are hoping also to recoup the expenses of research and development through high initial pricing. So, of course, research and development in accounting actually is, or normally they are considered as expense when incurred. However, there are cases when the result of this research and development will create a prototype that will later on become uh, the product already. So that is the case where we can actually invent, we can actually capitalize the research and development expenses, but this is seldom. Okay, that happens. Okay, again, mostly we or the company are incurring higher uh, amount on research and development, and then that's being considered as their expense. But in the case of pharmaceutical company, okay, before they are able to introduce new medicines or vaccines and any other type of medical solutions. So of course they have to go through research and development. This is a must on their part. That's why if you could notice, branded um, medicines cost higher. Okay, so after a period of like 5 years, other companies may now also create or produce, okay, the same product as that of the branded, and that is what we call generic. But the generic ones actually just copied the main ingredient of those branded medicines. So in this case, those generic pharmaceutical companies do not actually perform research and development. That's why their prices are lower. Okay, so that's an example. So here, a cost consideration is that in the startup phase of production, so here, economies of scale and learning effects have not yet occurred. So that's why all of these expenses at this stage are considered expense when incurred. It's not yet capitalized. So, closely related to scheming is price gouging. Okay, so what is price gouging? This is said to occur when the firm with market power price products too high. So how high is too high? Surely, of course, we will consider the cost. Okay? So anytime price just covers cost, gouging does not actually occur. It's not every time that the price just cover the cost. It's not gouging. Okay? So here, and this is why many firms go to considerable trouble to explain their cost structure and point out their cost that consumers may not realize to exist. So here, if the company will price higher, so they have to explain why is that so, especially if the consumers may not realize how they are able to come up with that costing or pricing. Okay, so pharmaceutical companies, okay, this is an example. Okay, emphasize the research and development as mentioned earlier. So here, they emphasize R&D expenses. That's why they price their medicines higher. Okay, so when a high price is not clearly supported by cost, buyers will take offense. Okay, but normally, price skimming and price gouging is not very common. Okay, so that's why the main policies or pricing policies and costing are those of the first two that we've mentioned. Okay, that is the cost base and cost based pricing and the target pricing and costing. Okay, so that is for the first part of our module.